brief opening prayer. Heavenly Father, we thank you for this day. We thank you for the gift of life and good health. As we spend some time to deliberate the matters affecting investments and the economy, we seek your wisdom, knowledge, and direction. Be with us. In Jesus' name I prayed. Amen. You're welcome once again to this special edition of the USE webinar series. Today we are going to handle a very fundamental topic: identifying and taking up investment opportunities. I will be your moderator for the day, a thermostat, if you may. I have to make sure that at the end of this 80 minutes or 70 minutes, we achieve the purpose of why we are here today. So wherever you're tuned in from, thank you for taking off some time to join us. It's something we don't take for granted. Our goal is, as much as possible, to give hope. The times and days we are in are not very positive, not so good per se, but we want to speak some hope, especially into the money matters. I want to discuss and see how that money some of you are making be able to grow. So I and the USE team have invested some time and resources to add value to you, whether you're an institutional investor, whether you're an individual seeking for some advice or ways to get better. We are here to assist you to achieve those objectives. So in the event that you have any challenges during this session, please contact Salma and Shenaz. Reach out to our numbers as well. You will get assisted. Make use of our chat room and all our social media handles such that you can be heard. We would have expected our CEO to give opening remarks. However, he will do so at the end. So I will give some background information to open up this discussion. We have fielded a very good team of investment professionals that can easily pass for finance grandmasters, generals. They are well known in the capital markets industry across the region, and they are the best to really tackle this topic for the day. I will give each of them 10 seconds to introduce themselves. Then I will come back and we open up. So Mr. Kusima Simon Mwebaze, in 10 seconds, who are you? Thank you.
Good morning, Andrew. Good morning, everyone. My name is Simon Mwebaze. I'm an investment professional and I head the investment business of UAP Mutual in Uganda. I'm very passionate about investments and I've been in this industry for about 15 years. It's something that is really driven by passion more than anything else. It's such a privilege for me to be here and I look forward to learning and engaging. Thank you. Back to you, Andrew.
Thank you, Simon. Over to you, Mr. Joram Ongula. 10 seconds.
Good morning. Good afternoon. My name is Joram Ongura. I am the Chief Executive of SBG Securities Uganda Limited. SBG Securities Uganda Limited is a subsidiary of Stanbic Holdings Uganda. I am quite been a player in the capital markets for over close to about 8 years and worked across the region and further beyond, looking into African markets. I really have a passion and I'm here to encourage everyone to make investment your lifestyle. Thank you, and nice to meet you.
Yeah, thank you, Joram. Mr. George Kaluma Mulindwa, who are you, what do you do, and why are you here today, sir?
Thank you, Andrew, and good morning to the attendees of this call. My name, as introduced, George Mulindwa. I work for Gen Africa Asset Managers. We're institutional fund managers in the region. We also manage funds within specifically Uganda, and we're key players in the Uganda Securities Exchange. Thank you for organizing this, and looking forward to the engagement. Thank you.
Thank you, George. And as we spoke, as we prepared, just to remember, the people in our audience at different spectrums. Some are experts, mature in the investment industry, others may not be. So in our discussions, we encourage you to strike that background. So as we prepare to jump into the discussion, just some brief background. The country and the world we are in right now is going through a difficult or tough time, which has been amplified by the pandemic. So a number of people, I'm sure, including you, running left and right to get vaccinated, to get treatment, or to get cured and healed of COVID. Yeah? So that's the beast we are fighting right now. However, Uganda is shy of 60 years of age. We are very familiar with poverty, with unemployment, with hunger, inflation, and a number of socio-economic diseases and viruses, if you like. Experts have fronted an improvement in saving and the investment culture as a medicine to some of these social ailments. So in our 70 minutes or thereabouts, we want to see how the capital markets as an industry, of course, through fusing both the saving and the investment, can help arrest some of these social diseases, poverty, and these challenges which people face in their day-to-day lives. Before I even ask, if you're to look at our 9 listed companies, the local ones, 8 out of 9 of them reported profitability in 2020. 2021 doesn't seem to be any different. However, we notice that the outlook, most investors seem to be bearish. That sense of hopelessness. So our first question for today, given the current investment environment in which we are in, wanted to get your opinions. What are some of your expectations as experts on the outlook of these conventional asset classes we have in our industry? Mr. Simon Kusima, you will bat first. You will open for us this discussion.
Thank you, Andrew. I really thought that the first shall be the last, so I thought George would handle that, but nonetheless. I'm really optimistic about the fortunes of our country. Like you've rightly put, a good number of the companies that are listed on the Securities Exchange in Uganda had growth in a pandemic year. Obviously, a good bit of that could have been even much better hadn't there been the pandemic. And we also have to think about how many of these businesses that are listed on the stock exchange are going to transition through this period and be able to remain resilient in the different sectors that they are participating. I think the benefit that many companies, especially those listed on the stock exchange, have is they have an opportunity to probably leverage on the stock exchange to even raise more capital that could even be patient in terms of long-term expectation. And if that is put into consideration, we are likely to see even more opportunities spring up. Again, when I look at the opportunity space, I see there are a number of sectors that are up and coming. There are a number of sectors that, or some companies that are particularly around the banking segment or finance segment, where we're likely to see there could be a bit of a dip here and there because of non-performing loans from some of these. But broadly speaking, I think current prices on the stock exchange are fair. I've been looking at things like the dividend yield as a whole for the stock exchange. It's averaging somewhere in the regions of about 7 or 6%. And when I compare that, for example, to what we're seeing, for example, in the interest rate market or in the debt market, the bond market, where the one-year treasury bill rate is at 9%. So you're seeing dividend yields almost at par with interest rates, at least short-term interest rates. So that would obviously speak into some good undervaluation there that investors or people who would wish to participate in the capital markets can take on, because you're better off earning a dividend of say a dividend yield of say 8 or 9% that is going to grow every year or over the years as long as the business fortunes get better, compared to just locking in a 9% rate and probably hoping that along the way interest rates will move favorable. In addition, the investor will know that beyond the dividend that is earning from the investment that he has undertaken, there is also going to be a possible price appreciation as many of these businesses navigate the pandemic and come out even much stronger. I'll give you an example. You saw how even in the pandemic year, some of the banks, some of the businesses in the banking sector have still managed to maintain adequate solvency levels, but also gone on to turn a profit. So that is quite encouraging. We want to see how things will appear probably 2, 3, 4 years from now, once many of these businesses have navigated this. And also another thing to note, some of these businesses have had to make changes to the way they operate. We've seen some businesses scaling down on for example, the floor space they used to occupy previously. And that has, in a way, freed up cash flow because they've been able to maybe invest heavily in digital. They've been able to figure out a way of how to work even in such circumstances. So with such innovation, again, it's likely to bring a very positive dividend to these businesses in the years ahead. I think I can stop here.
Thank you, Simon, for opening the discussion and batting very nicely. Joram, we wanted to get your thoughts on this question as well.
All right, thank you, Andrew. Mine will be quite different from what Simon has just said, but if I could just add on to what he has said and relate it to the local man out there or the initial investor, is we've seen the disruption, as a result of COVID, and some of this has really impacted some of the businesses. So you'd find that me and you assume we're sole proprietors or had a partnership and we're selling very kind of a kiosk kind of business. You find that during this lockdown, you've massively been impacted by this. So you'd find that some of the companies that listed on the Uganda exchange are able to resist some of these shocks, in that they kind of have tend to have a large balance sheet, and this is able to caution them over such very unfriendly times. And you find that over time, when the economies also tend to recover, as the vaccine and everyone else is getting vaccinated, we anticipate the economy will recover. And we've even seen it from some of the data that Deloitte had shared, where they anticipated the our economy to grow by about 6.3%. So you find that, once we vaccinated, this growth is coming to the companies that intend eventually to pick up and prosper further will probably be most of these large, institutions. I'll stop there. Thank you.
Welcome. George, I also want to believe your opinion may not be so different, but as you give your opinion, I also wanted you to speak to a maize trader in Masindi, a fisherman, maybe in Karangara, and a hardware dealer in Guru. As you bring your opinions on your expectations and the outlook, speak about the opportunities some of these people who are not perhaps very exposed to the financial markets. What are some opportunities that are in there for them? Give us your opinion and set us into the next motion as well. Thanks.
Okay, thank you, Andrew, for the question. I think just a comment on expectations of asset classes, more capital markets related. I'll start with that. Then I'll go to what is really considered the real economy. So the stock exchange or the capital markets are a reflection of the reality that is going on in the rest of the economy. So if there's an interruption, if there are restrictions, if there's lack of productivity in the wider economy, it naturally will show up, for example, on the stock exchange, either through analyst opinions or investors trying to get ahead of the curve in terms of taking investment opportunities. So the fact that the economy has slowed down, it will reflect on the markets. And I think we had a fairly difficult last year. Even this year, I imagine is not going to be a good year. As I said, the companies that are listed are operating in the economy in which we exist. So you cannot separate these ecosystems. To make a comment away from the financial markets, to speak more specifically about the real economy, where actual goods and services are produced, are exchanged, are paid for. It's certainly been tough. If you cannot move, then you cannot transact. So maize trader, fisherman, even the restrictions they were facing prior to the pandemic, notwithstanding, the friction between Uganda and Kenya in terms of maize, the fishing restrictions on the lake, your usual hardware dealer, given the vagaries of that particular industry, the pandemic has then come to add more difficulty onto that. What can we look at as an optimistic view for the real, everyday investor in an SME? One, looking 12 months out, I think we will have got a grip of this pandemic. I expect the economy will be able to reopen up, businesses will be able to operate, trade will resume. So that in of itself is an optimistic view. And I think the second and last that I'll add at this point is to then encourage the everyday man, the everyday business owner, to look at savings. Savings is very critical. If you did not have savings at this time, I'm sure you're folded or you're in very difficult times. But let the pandemic be a lesson to all of us. Check savings adequacy. That is the only thing that can keep small business operating. And later on, we'll discuss how savings can help investors in the capital market. Thank you very much.
Thank you, George, for those nice ideas. Joram, I wanted you to add into that discussion on the opportunities for somebody outside our environment, that person in Soroti, that person in Guru, because there's that detachment outside the CBD. Many people don't seem to comprehend what we speak about. So, what, in your opinion, what are those opportunities these guys can also enjoy to take part in our markets?
Thank you, Andrew. Quite a number of opportunities. One that Simon had actually mentioned is first is the opportunity in getting into these stocks at quite fair prices or fair valuations, and for the opportunity here definitely goes out to one, reaching out to some of the brokers and just requesting for some specific information on how to get started, as well as guide them on how to build an investment portfolio. We appreciate our fellow Ugandans out there quite busy running their businesses or having their jobs. So it's best is always just reach out to an investment advisor and just guide you on how to build a portfolio. It's quite important, especially when you to take advantage of some of these opportunities, is for you to have a very well balanced portfolio that ideally, you have an allocation to equities, you'd have an allocation to fixed income, and then you'd probably have an allocation to collective investment unit trust schemes. And again, purely it would also, the guidance for my fellow Ugandans out there is to look at what is your risk appetite. Yeah, what is the risk appetite? So if I really have money that I ideally want to use, in the next 1-2 years, ideally, equities might probably be the bad opportunity for you, especially if you look to exit in that short time of time, because as you've seen, the economy takes a while to recover, and same applies to most of these listed companies. So equities would ideally be recommended for somebody who's coming in to look for more than 5, close to 7 years, and that is when you'd ideally make quite an interesting investment. And then also, besides that, if you're looking for a couple of again, within your risk appetite, and you're looking, you're kind of vast about going into an investment, and you ideally have no idea, the benefit for you is to say, how about I allocate this money to to a professional manager under the collective investment unit trust, who will manage this money for you and try to give you very competitive returns. Thank you, Andrew.
Welcome. Thank you for that. At least you've widened the playfield. Simon, I wonder if you have some thoughts on that, but we also wanted you to quickly, as we begin going into the deep end, to speak into the processes for somebody not familiar with shares, with stocks, but they would like to participate with fixed income instruments. How would they perhaps take part? What are those processes they have to undergo? So speak widely, since you at least had a firm which almost offers all these different services.
Yeah.
To somebody who may not be familiar with them.
Okay. So I think the way I try to visualize my response is really around the same way I would imagine myself going. Maybe I'm driving my car and I get a car problem, or I'm navigating my usual way of life, and maybe I get a health problem. Most times it would be very disastrous for me to self-diagnose. So that's why it is really, really important to consider having an investment advisor who really, their job is to make sure that, first and foremost, like a doctor, they can clearly understand the kind of situations that you're going through as an individual or as an entity, and then help you to come up with some form of investment plan that you can work with, and evaluate it over time to see whether you're making progress or not. The same way you'd have your relationship with, say a doctor or your mechanic that you routinely go to check and service your vehicles. It's the same relationship, because many of these financial instruments, they're not so complex, but if you don't understand them, you can actually lose a lot of money. And then you can have a very bad experience, and then you leave the table, and then you find that time has passed by, you've not really grown. So the role of the advisor is extremely important. Now, once you've finished probably having such discussions, the next place would be to come up, then the next step would be to come up with an ideal suite of investments or options that would be able to meet your goals and objectives that have come out of the discussion you've had with your advisor. Same way, when you have a session with a doctor, at the end, he's able to prescribe probably what your condition is, and then also prescribe how to manage it or how to contain it. So it's the same way. So you basically come up with maybe a basket of investments that could help you achieve that objective. Now, that basket could include what we call fixed income investments or interest-bearing assets, but that bucket could also include stocks or shares, quoted shares on the Securities Exchange. Now, the constitution or how you constitute that bucket will purely be dependent on the kind of discussion that you've had with your advisor, and mainly it's around how you're going to balance probably the return or the reward that you want to get from your investment or your portfolio vis-a-vis the risk that you are comfortable taking on. Joram said that if you're looking at investing in the stock market, you're looking at maybe investment horizons of 2 year, 3 year, 5 year, 7 year. So it's generally speaking a long-term approach. Now, the process of setting up many of this is very much straightforward. It's basically having understood which direction or how you're going to execute. You then have to talk to your advisor to guide you on setting up. Now, shares are held electronically through an account that is called an SCD account, Securities Central Depository Account, and this is where shares are going. The shares that you will be buying will be held in that. So you would have to open up an account, and the stock exchange, the Uganda Securities Exchange, has done a tremendous job by automating this process. So you can actually do it on your own by logging onto the USE website and going ahead to go through the entire processes to have the account set up. Now, you can also do this through your advisor, and the stockbroker helps you get that whole process done. Now, you might also choose to allocate your capital in interest-bearing assets, and there is a wide variety of options. You could, for example, buy treasury bills, treasury bonds, etc. Now, all those government securities or government bills and bonds are also held through electronic accounts. Now, again, the advisor can assist with that. And again, the Uganda Securities Exchange has put in place a mechanism through which you can be able to participate in these same instruments. Again, you can do it directly through your advisor or even through the bank that you're working with. But just to emphasize the most important thing, the execution is important, but the most important thing is the thought process or the applicability. Andrew, in your earlier mention, you said for the most part, people, investors have been buying shares, and maybe they buy like a small, they invest less than 100 or 200,000 shillings in a particular stock, and then they'll never have activity thereafter. And the reason why such instances happen is because they've not had the time or the opportunity to sit down with an advisor to have these sessions and come up with a deliberate plan that should be implemented and followed or reviewed or tracked periodically know that there is progress. And actually, the people or the institutions that have transited from what I would refer to as a subsistence form of investing to something that is actually life-changing are those that have been a bit more deliberate and have had such conversations with the advisor. And it's amazing how much you can achieve over time when you have such discussions and such intentionality about your finances and about what you hope to achieve or where you hope to be, say 3 years from now, 5 years from now, and 15 years from now. Andre, I think I can submit.
Yes, thank you very much, Simon. Yeah, it has been detailed and thoroughly answered. To George and to Joram, we shall split this. Let me start with you, George. Many times when we have the privilege to speak to investors, they usually ask this question: where maybe I've struggled so hard, I've sold some cows somewhere in Mbarara, which is the best company I can put my money into? But maybe for purposes of being a bit holistic, do you see any potential, especially mid to long term, in some of our listed companies? You could give us an industry-wide perspective.
Well, once again, thank you, Andrew. So to tie up what my colleagues said about available opportunities, which will lead me into discussing what available options there are. I think, Andrew, it's imperative or even a responsibility of ours to encourage a change of mindset, or you could say to encourage investors or potential investors to start to look at investing as a habit, not as an event. So as opposed to participating in the market when there's an IPO, or buying a bond when they're trading at very attractive prices, I think we need to push for change in mindset. And why do I say that? Using the analogy of, for example, a sportsman, you can't possibly start to train on the day of the final. And I will relate that to the opportunities. You cannot realize an opportunity if you are not in the market. So for me, what I would really be pushing for as a start is that investors or potential investors dip their feet in this market, in this industry. If it's a habit, then you will find it very easy to identify opportunities, because truth be told, some opportunities will pass you by, but there are always opportunities that are coming. The pandemic has presented an opportunity in the equities market that shares of so many companies fell so far down last year, and that was an opportunity to purchase, to buy, because many of these companies are very decent companies. However, if, as Simon said, if you don't have a depository account, if you don't have, if you're really out of the market, then you honestly cannot participate. Same thing has happened. You will allow me to use example of Uganda Clays. Uganda Clays, the share last month, as recently as last month, May, okay, the other month, Uganda Clays was trading at 5 shillings, 5 Uganda shillings. Uganda Clays is now at 8 Uganda shillings. The difference between the 5 and the 8 is a 60% return. So, but very often you hear many, investors say Uganda Securities Exchange doesn't work, it doesn't, but it works. It works only if you're in. It doesn't work if you stay out and analyze and compare and do all sorts of, armchair analysis. You really have to get your feet in the game. The advice I would give to the saver that you mentioned, who has who has realized some cash, is to get into the habit of investing, even if it's in the capital market. Things like bonds, things like equities, there are people who can help them. But please do not come in for one opportunity. That is what has caused. It has cost people so much money. It has caused the markets to have a very poor reputation because investors come in for that single opportunity. There's an IPO, let me borrow so much money, and I put all of it in the IPO. There is, government is borrowing more, let me borrow so much money and put it in a bond. The odds of you losing on that single decision are relatively high because you don't know what's going to happen. But if it's a habit, you've been buying, share A, B, C, D. During that process, you'll get some losses without a doubt. Maybe C will be a poor stock to hold. Maybe D will be a poor stock to hold. But as you realize the opportunities and the losses, you then become aware to, where now can I put the bulk of the money? But you need to be in. You can't be out and hope to realize the potential or the opportunities that the stock market promises. Just as I close up on this, again, to use another example, if you look at even Stanbic Bank, the share or Stanbic Holdings, I think between the beginning of the year and now, Stanbic is up 17%. 17% in 6 months. You cannot get that in any business during a pandemic, during a period like this. I've already talked about Safaricom. I've already talked about BAT. Safaricom is another example. It's in the region. Last year, trading 25. Right now, it's at 40. Immense gain, but you have to be in. You have to be playing the game to really be able to benefit from it. And fixed income is also very similar. Between end of year up to now, there's so much gain that has happened on so many fixed income securities. But again, if you are not in, then it becomes very difficult. So to give Simon's advice, open a depository account, at Bank of Uganda, at the USC, start to put little money aside. Then the opportunities will become apparent when you already can execute. Thanks, Andrew.
Welcome. Thank you, George. I hope I'm much more audible. I want to apologize to our guests. Apparently, I wasn't very loud enough. Mr. Joram Ongura, we wanted you to give your perspective regarding fixed income as an asset class, okay, in the Ugandan and the regional context. So many countries, Uganda inclusive, are borrowing just to survive, to feed the people. I believe some of you could have received that 100K to buy some soap and food. So if we keep borrowing and there's this slowdown in the economy, is fixed income still attractive as an asset class? You could use the Ugandan and the regional perspective. What are your thoughts?
All right, thank you, Andrew. Before I could even respond to that, I just wanted to share this example that I saw in one of the Asian countries. It's hopefully it's motivation to everyone there. I got to find out actually a couple of months ago that trading can actually be a profession for we Ugandans across. In Japan, you find that most of these mothers who are retired, once you leave employment and you retire back in your home, you actually find that they're actually traders. They sit behind their computers every day and take positions. So basically, most times they tend to trade more in terms of the technical trading, where ideally you're looking at demand and supply. So you'd find that because the markets, if you bought today, you can actually settle the same day. So you'd find that these mothers follow the news any one time, they know any sentiments coming and they would react and take some positions. So anyone out there, trading can always be a profession for you. And going going back to the fixed income. So we've seen that over time, the central bank rate has been, coming off. And as a result of that, we've noticed that, for the commercial banks and, for the risk that, they would ideally, impact is left towards them, you find that, banks have tended towards to invest more into fixed income government bonds because, one, they are risk-free, as opposed to actually coming to give a loan to me, who, could ideally default based on, the factors we know that, the disruption in the economy. So because of that, we've seen quite a number of, we've seen quite a rally, across the rates in the fixed income space, with more of, pension and offshore asset managers coming in. And these rates have really moved significantly. And with recently we saw again the central bank rate being moved by 0.5% to 6.5%. Again, that also brings the debate and say how far would banks want to would these rates move much lower? But across the board, there's been quite interest from the banks and the long-term money in that as guys move away from safety to risk. So again, tomorrow, once everything, the economy is back to normal, then we'd see now, we now see that, the investors switching from, from safety and going towards risk. So for right now, I would recommend for, the opportunities there for us, but it's not as significant from, from the times, from about 12 months ago or 6 months ago. However, I would still recommend again, it's always best to diversify your portfolio. Is when one side of the basket is impacted, by market factors beyond you, it's the other assets that you invested in the other asset class is able to caution you from such an impact. I beg to submit. Thank you.
Thank you, Joram. To stick around fixed income a bit, I will get back to you, Mr. Kusima Mwebaze. One challenge we have faced in this industry, especially regarding issuances, has been the very high yields. Of course, somebody trying to issue a corporate bond, I believe, starts determining the possible cost by starting with maybe what a 10-year instrument, what government is using to borrow, maybe 10-year, 15-year, the long-term yields. So do you think the time is nigh for some of these companies to reconsider issuing corporate bonds? That is the first question for you. But since we are running out of time, immediately after that, I wanted you to give some insights and words of wisdom to a retail investor, a child who is maybe was just graduated, our mothers and fathers who have recently retired, and they are trying to look for hope at this time. They have tried rearing pigs, rearing chicken, and things are not working out. Share some insights from our perspective on how their losses can reduce and maybe make some returns. Over to you, Simon.
All right. So the case for corporate bonds, I think now more than ever makes a lot of sense. And the rationale is, I don't know whether the banks are having a lot of appetite right now to deploy capital in such instances, and most especially when you're coming off or you're into a pandemic period where revenue collection for most of the businesses is not as assured or is not as certain as how it used to be. So of course, the case for patient capital makes a lot of sense right now. And of course, if you compare it to, if you look at the pricing, for example, 10-year instruments, 10-year bonds are trading somewhere in the regions of about 14.5, give or take. So it's fair. It's good to assume that a company that was well packaged could easily borrow capital, maybe 2 percentage points above that, maybe at 16.5 or even at the same rate, by the way, because depending on how the deal has been structured. But what makes most sense is the fact that this is patient capital. Normally with these corporate bonds, you find that you're paying interest basically every 6 months, and average tenor is always maybe 3 years, 5 years, 7 years, give or take. So you would find that as a business, if you are having, if you've considered taking on capital from the debt market by moving into the corporate bond segment, you're going to most likely benefit from the fact that you can pay interest every 6 months. The loan can be amortizing or non-amortizing. So what that basically means is you could take on this funding and with an aim of paying off the proceeds on maturity, which could be 5 years, which could be 3 years, which could be 7 years. But in the interim, every 6 months, you're paying an interest to the investor. So that makes a lot of sense because it gives the business very patient capital to expand, to invest in research and development, to get into new markets or even new products, or even to refinance already existing loans. So the case for corporate bonds is strong. I really don't know, by the way, why we have not seen a lot of companies come onto the bond market to raise capital, but the case is very strong. I think, personally speaking, it is an avenue that would be, if someone was careful, can actually raise capital and actually do something very well with it. Words of wisdom, I don't know. I think I should be on the other side receiving the wisdom. But what I can say that I've learned over the few years I've been in the industry is there are certain themes that are constant. And even as we've been having this discussion, these themes have been coming up every so often. Key themes like diversification, key themes like knowing exactly what you're doing, key themes like having an advisor, an investment advisor who can hold your hand and guide you to navigate into the turbulent times. Key themes like patience. I think patience is very good. I'll just say one or two things about my personal experience. One thing I've noticed is from the years that I've been participating in the capital markets is if you have a fair grip of knowledge, you don't have to be an expert, as long as you have a fair grip of knowledge of what to look out for. The same way when someone is looking for a wife to marry or a mate, you don't know exactly who they are, but you know the kind of attributes that would easily lead you to the right person or the person that you would consider. Now, if you have that kind of thinking and you're patient, opportunities from time to time will always come, and you be active and engage and make money. Of course, the kind of advice that a retiree or a mother out there in retirement who is giving her hand at farming wouldn't be the same advice I would give to a student who is just out of campus or college and they are starting out in life. The personalities are different, but the themes are constant. First of all, knowing exactly what you're doing, having a discussion with an advisor, being deliberate and intentional about your investment goals and plans and tracking them every 6 months or every 1 year. Incidentally, we do this on a day-to-day basis at our workplaces. So you will find that at the company you're working for, at your business or your enterprise, you strategize, you go into strategy retreats, you bring on board experts to come and advise you, consultants. You will drop budgets and you will keep evaluating yourself vis-a-vis the budget as an institution, as an organization. However, when you look at our personal lives, we don't apply that same that same energy or that same consistency. And so there is always a disconnect, because you'll find that an individual is, for example, very careful and meticulous in managing a company's budget, but a bit of here and there when it comes to their personal finance and their personal wealth, which at the end of the day is what really matters, because you will leave that organization, or probably the organization may not be there tomorrow while you are there, or while people who are impacted by you are still there. So that same thought process, so that same thinking is what needs to be applied to these investments. I like the example that George gave of the athlete, that no one, you don't prepare, you don't start preparing on the day of the final. It's an everyday activity. You don't wait for the IPO and that's when you go and buy MTN, or that's when you go and buy Airtel, or that's when you go and buy whichever company. No, it's a habit, it's a way of life. And then also, you have to be able to be patient. You have to be able to sit back. No one will plant there, no one will sow a seed today and tomorrow come for the fruit. You water it, you nurture it, and you prune, you tend your garden, and after some time, then you start seeing fruits materialize. And I think why I'm so upbeat about financial markets, the truth is, the amount of energy that and effort that you put in managing your personal finance, especially within the financial markets, is probably a tenth of the energy that you'd probably put in managing any other portfolio or any other investment or any other business, because most of these investments are passive. You just need to have a degree of patience and just know what you're doing, or have someone who is advising you accurately, and just be patient and just sit back and just keep doing it over and over and over and over. You'll be surprised. At the end of 5 years, probably you set up with a goal of maybe saying that by the end of the next 5 years, I should have, maybe, we're now in 2021, by 2026 or 2025, at the end, I should have an investment portfolio of maybe 100 million, or maybe 70 million, whatever the case may be. And then you just keep doing it every single month, discipline. I remember how I got into this journey was when I was at a certain camp, and a youth camp, and there's this financial literacy guy that came and had a session with us and just gave us scenarios of a workplace where the driver of the boss at the end of maybe 7 years was relatively wealthy compared to the boss that he was driving at the end of those 7 years, because the boss couldn't live without the job, yet the driver could comfortably live without the driving job, because he had over time saved and invested and accumulated some bit of wealth. And that's the same thing that's the ethos that entered me from then, and I've been practicing it. So I can say with a degree of comfort that the capital markets work. You can make a lot of money. You just have to be patient. You have to be knowing what you're doing, have an investor that you're engaging, and it's good to test. There's no one who should be, you don't treat your money like the way you support Liverpool or the way you support Manchester United, whereby if returns are rubbish, you say, no, I'm going to take there because this is my team. No, at the end of the day, it's personal finance. If the investment that you've undertaken has had years of bleeding, cut your losses, move on, go on to the next, and ride it. Or probably if the advisor that you've been working with is not taking you to the promised land, maybe you reevaluate and put them on pressure. It's always good to be as intentional or as deliberate with our personal finances. Don't make it cultic. Don't make it I have to stick with these guys just because they have the best colors when it comes to their logos and things like that. No. It has to be, what value am I getting at the end of the day? And that value will come from the investments that I take. And probably I've been given advice by so-and-so, and I've seen it over the years. It has worked. Thank you.
Yeah, thank you, Mr. Kusima Mwebaze, for those nice words. I know we are, our time is also running very fast. And for the next questions, I will ask my panelists to use a minute or less such that we open up the floor for the broader discussion. Before I get to Joram and lastly George, Simon has said many things, but two have really stuck out for me, which I think can help all of us. You do not have to have, okay, what the English guys call a stratospheric IQ. You don't need to be an Isaac Newton to excel in investments in the financial markets. If you just do the basics, I think this is a message Joram, even George has told us. So you don't need to be so complicated to be a mathematician, a doctor, to excel in these things. Sometimes the basics will do the magic for you. Then that point of being passive, that's why I wanted to bring these examples of somebody haggling. Yeah? You come from Mbale, but you have to go to Masindi to buy maize. You have to run to Mubende to buy beans, then take to Owino. These things are good, but if you're to take a critical look at these things, that margin you're looking for, 10 shillings or 30 shillings, you can actually use that very mentality and approach of shares. You buy it at 27, passively give it some time to wait, perhaps after 3 months or 4 months, that 27 can be 30. So thank you very much, Mr. Simon Mwebaze. Joram Ongura, we don't have too much time because of what we still have ahead. I think we have about 30 to 20 minutes left. As SBG, I know you very well. I think over the last 10 or plus years, you've done wonders and really brought foreign investors at the US in stocks in particular. Do you have any innovations? Do you have anything new for these guys? Perhaps share some insights. If there are some innovations as well as your firm, this is the only chance you have to speak to that audience as well in a minute or two.
And appreciate words of me. As a person, as Joram, there have been
Joram, are you breaking? You seem to be breaking. You seem to be breaking, Joram. Maybe you turn off the video and speak. But as we allow Joram's connection to get back, I wanted to give Mr. George Kaluma a minute for our retirement funds, circles, investment clubs, and these small institutions. Just conclude with some insights, maybe as Gen Africa, anything innovative you have for 2021 going forward that can perhaps improve returns and make these guys happy.
Thanks, Andrew. And from our team at Gen Africa, it will surprise you or not if I said, from July of 2020 to June of 2021 has been a very exciting year in terms of opportunities, both buying shares, which are equities, but also on the fixed income front. So, those past 12 months have actually been fairly decent. And why? Because the institutional investors, and I would like to include circles, they are habitual investors. They don't come to the market when there's a good opportunity or when there's a party or whatever. They are in the market every day. So they ride out the bad news and they definitely benefit, from the good news. So we've taken, starting last year or even 12 months prior to that, we're very active in the fixed income space. We're buying government bonds. You had a question on government borrowing, and for us, we want to look at credit risk. If I expect that you will pay me back, then I can lend you money. And these institutional investors have taken advantage of these opportunities, and they are seated on some amazing, both realized and unrealized returns. Because last year government was very desperate to borrow, and they borrowed fairly massively. These institutions are now benefiting from those high interest rates, which they locked in at the time. So for them, you could say, to answer your question, what advice would I give institutional funds? They're already in that space. They're habitual investors. Maybe to tie it up is the ability to realize gains when it makes sense. I think that's an area where we've not done very well as institutional investors or as institutional fund managers. We buy a stock and hold it until kingdom come. And that has led to lack of liquidity, very low activity on the exchange. And we take some blame for that. So as institutional investors, I would advise within this year, realize some of the gains. Don't ride this wave, this never-ending wave where you are happy and you're sad and you're happy, but you never pull out the money. So for some of the shares, for some of the fixed income, this is a decent time to realize those gains, get that money out, realize it, look for other opportunities, again, within the capital markets, which we've done fairly decently over the past year. So that's the advice I would give to institutional investors. Realize some of your gains. Don't just ride the wave endless. Thank you.
Thank you, Mr. Karuma, for being brief. Joram, are you back?
Hi, Andrew.
Joram?
I am back. Sorry,
Yes.
I
Okay.
got disconnected the internet. Sorry, I'm back. Thank you. Oh, hi, Andrew. Sorry. So if I could just answer the question. And sorry, I got disconnected in the middle of answering the question. Apologies, everyone.
Joram. Seems you're having a not so good.
Joram is somewhere stuck, I think, under a rock. He needs to stand on a tree.
Joram, I think whenever you're ready, you may have to type the response. To our panelists and attendees, I would like to request you to lend us just 15 minutes to address all the questions that have come through the chat. And maybe for those of you who can't type, have challenges with typing these questions in the chat, you can actually raise your hand and we take your questions. So the Q&A is open. Please put up your hand. We shall be guided by Salman Shenaz, such that at least we listen from you. The experts have spoken. Yeah, as you raise your hand, panelists, please, you can look around the participants. Whoever puts their hand, you alert me, but there are questions which have also come through the chat. I believe some of them have been answered. the minimum one requires to buy shares in a company. I think Simon, you can take on that. Let me just let me allocate questions to each of us such that we answer quickly. Okay, somebody anonymous. Okay, someone is lamenting, isn't it? He uses a strong word there, that why should we encourage investments in shares, yet they are very exposed to politics. He gives an example of Umeme. Many of them invested in Umeme, but they have watched with horror as the price drops due to the threatening statements from His Excellency General Yoweri Kaguta Museveni. I think Mr. Kusima, you will take on that one as well. Minimum one requires to buy a share, exposure to politics. Then how sure are we that Stanbic won't be the next or CIPRA to reckless statements that encourage illiquidity of our stocks? So the question on illiquidity, CIPRA is not illiquid per se, but George, you will answer that question on liquidity. Which investment advisors are on the market, and also could we get a case study of an ideal investment portfolio for an individual, low to middle income? I believe Simon answered this. We shall leave it, but maybe in a second you will remind them. Then Mr. Higenyi, thank you, Simon. The problem is with our brokers. They don't reach out or even encourage us to invest more in the capital markets. You should encourage the advisors to speak to us. Joram, you will answer that. Initiatives we have as brokers and players in the industry to reach out to investors. MTN, Airtel, and Lika are set to float shares in the near future following the NTO. Could you speak on how a retail investor can get ready to size this opportunity? George Karuma Mulindwa, that one is for you. A question from Miriam Buhure. Peter asks, if you had 100 million today, where would you invest and why? I believe, George, you answered that, but you could in a second just do a reminder as well. Then how do we develop trust in the USE in order to invest, because we have negative movements in the prices? The questions are many and endless. I believe we have balanced. Joram, I hope you're back. You will take on about 3, Simon 3, George 3. Then we take a hand and yeah, Joram, if you're ready, please go first.
All right, thank you, Andrew. Sorry, Andrew, I just had to connect on my phone. Apologies, everyone, again for that interruption. I'll just dive into the questions, and I joined in when I think you had already mentioned a couple of questions. I just know 3. One is the initiatives to reach out to, as brokers, to reach out to the investors. One of the initiatives we've seen that we must congratulate the USE is to appreciate that we've also now moving into the technical space, moving into a platform business. So the USE has introduced a new initiative where you can actually open your accounts remotely. Before, you actually had to walk up to a broker's office to actually get this paperwork put through to the USE. Now it's remotely using your phone. This information is right in front of you. And then thirdly, also, if you've noticed in the last couple of months, there's quite been so much PR out there from our regulator, and all part of this is just to encourage, and also create an awareness among Ugandans. Besides that, we've also seen a couple of, I would just comment as SBG, one is also moving into a platform business. and that we're going to continue engaging with our customers, having appreciated that now businesses move from products to actual client centricity. So is what kind of products are the customers actually looking out for is the products we intend to bring to this market. So going forward, definitely, there'll be so much information in front of you from research into just also awareness about the opportunities in the market. Thank you. I think I had somebody ask regard to Stanbic becoming a CIPLA. I don't know if I got that question. Andrew, if you could just read that for me, then I could briefly comment on that.
The question was to do with illiquidity.
Okay.
That, is there that risk that Stanbic can reach that battle status? You fail to trade in maybe 5 to 10 years. Liquidity, okay. That's
all right.
A risk. Yeah.
Oh, all right. Thank you for raising that point. I'm sure, before we get to the point of illiquidity, ideally means, in a market of demand and supply. So once it's quite a bit of demand, again, it goes back to the fundamental is the actual true performance of the company. So as a result of that, there's been quite appetite, for such as perspective for, say, Stanbic holding stock. And the problem with that also, results into the stock getting illiquid. And I think some of the avenues or initiatives coming from the exchange is trying to develop a market that would allow borrowing and lending of stock. So this ideally should also come in to sort some of these liquidity issues, and as well as a couple of engagements we're having with our different buy-side customers, where we're trying to say, can we bring at least a market maker to try to buff up activity. In that, anytime you can exit and anytime you can come in and out, because this has also been not just a challenge for retail investors, but it's been a concern for the institutional investors. So yes, definitely we don't expect to see that so soon. And again, it's the buyer's price. So, it's the seller's price. So whatever price the buyer can appreciate of a specific stock and is happy to pay for that, then they actually get stock. In the last couple of 2-3 days, I think we've seen Stanbic quite move a bit of a sizable amount. And this is more investors also reacting, having gotten their first dividend and said, let's take a bit of profit for now. I beg to submit. Thank you.
Thank you very much, Joram. To Shenaz and Salma, are you able to unmute Celia such that she can ask a question? Her hand is up.
Cecilia, you may unmute and proceed to speak.
Sorry, I think my hand must have gone up accidentally, but thanks for the presentation.
Okay. Thank you. Tim Ham, I see your hand is up.
Tim, please unmute.
Hello, can you hear me?
Yes.
Yes, my question is, I think, to the three panelists, as asking what products and services, if so, do they offer to the retail investor?
Okay, thank you, Tim. Simon, you will, as you come on to speak, you will add that question of Tim. Regan, your question, sir?
Thank you so much for the discussion. I asked a question in the chat and it wasn't tackled. As an initial investor in stock market, I was inquiring if somebody hated betting way back. So it seemed the way how Mr. George explained the whole system, it's as if you have to do like betting. There are odds, stock must rise, stock must come down. So I was inquiring, how do you encourage someone who is a starter into that stock market? Thank you so much.
Okay, George, you will, as you come on, you will also use that Mr. Kamuntu, sir.
Yes, thanks, guys. Just a quick question. I had sent also a question on the chat. Does any of the brokers use any online trade tool? Because I think talking about liquidity, I think this is one of the things that can greatly help. But I'd like to hear from the brokers if there are any tools they're planning to introduce for some of us retail traders, instead of having to physically look for the brokers every time we want to trade in a stock. Thanks.
Okay, thank you, Mr. Kamuntu. And lastly, Dr. Denson. Huh? You have
Hello.
the privilege of asking the last question.
Can you?
Yes, yes, Doctor.
Yes. Yes. Thank you very much. Now, I belong to the pool of retirees, and my question is: retirees are a potential pool of investors because a good number of them have retirement packages. Others have been saving some money in plan for retirement. But as we think of investment, there are issues that retirees have. First of all, they are old. Therefore, the issue of disease prevention becomes big. And therefore, as they invest, that should be taken into account. So I've been thinking in my few years in retirement, I've been thinking in terms of farming, because if you are on a farm, most of the things you need as a retiree are to do with the nutrition. So if you are on a farm, the cost of feeding on the right items is the chances of that are high. And I've seen a number of recommendations relating to what I think are likely to be nice investments. For example, goat keeping. There's a lot being talked about goat keeping. So can the experts please look at what advice would be given to retirees in investments to take care of their health, that is nutrition, but also as you retire, you are likely to be lonely, so there is the need to keep a number of people around you. So an investment that can handle the issues that face retirees as old people, so that they can contribute to the economy of this country. Because as I said, they are a group that have a good amount of money that can be invested. Thank you.
Thank you. Ladies and gentlemen, we have that time constraint. You will allow me to request Galaxy and Mr. Muhanguzi to send through their questions in the chat. You will allow us to answer them offline. Mr. Kusima Mwebaze, you will take on the question of Doctor which came through, and you will also wrap up, give your closing remarks in addition to the other questions. But yeah, you go first, then George will also take on the questions which were allotted to him, and the other which came through, which was specific, as he wraps up also. Then Joram, you will come back and speak about technology, because you had already hinted on it, and wrap up as well. So George Mulindwa, you will go first.
Yeah, thanks, Andrew, for that, and thanks to the participants that have raised these very interesting questions. The first question I'll attempt to address was the question of illiquidity. You buy a stock and you cannot sell it. Earlier in my presentation, I said there's a structural gap where institutional investors get into positions or they buy shares and they never sell them, and you kind of have that lock, demand and supply not quite meeting. What actually moves most share prices down are retail investors. Someone who is trying to pay school fees, someone who is trying to get money to spend during Christmas, someone who is trying to survive a pandemic. They will sell shares regardless of the price, just to raise some money. And this is where you find these prices are going down below even the actual valuation. To answer the question of illiquidity, as Joram mentioned, we need market makers. This is a bit technical. We need to sit as institutional investors and the exchanges to see, how do I buy every time I want to buy and sell every time I want to sell? Can the listed companies help with this? Can they provide some capital to market make? Otherwise, you have a very dull, almost inactive stock exchange, because institutions are not selling, retail are selling at whatever price. So that gap really remains unanswered. How do we prepare for the IPOs that are coming up? One, talk to your broker, talk to your dealer, ask them very pertinent questions about these companies. Whatever questions you want to ask, the dealer or the broker should be able to answer them. Exercise some caution. The story of Safaricom, those who are here, those who are alive at that time, really left a mark in my mind, where so many of us borrowed so much money just to invest in one stock, hoping to make a quick buck, and that wasn't the case. So get as much information as possible from your dealers, from your brokers, before you commit funds. If you had 100 million, where would you invest it? This is one of the most common questions from as soon as someone knows that you're in the investment space, they will pose such a question. There are so many riders on that question, because my 100 million is not the same as the next 100 million. If you raise 100 million and you have children that are going to school and you still need to pay school fees, your risk, ability is so different from a retiree, for example, Benson, who has 100 million and his only care really is medical bills. So to answer you, I would have to understand your circumstances as an individual before I can advise you on how to invest your 100 million. It could be your last 100 million, and to lose it will cause you so much distress you will never recover. Or it could be 100 million out of another maybe 20, 30, 100 million pool. The investments would be so different to advise on. I'll try to tackle Reagan's about getting into the market. Again, I apologize if I made it seem like it's betting. It's actually very diligent work and requires a lot of attention, a lot of research. For you to be able to take part in the opportunities, you must be in the market. That's what I remember saying. Do not enter the market, or don't come into the market for a one-off where you're hoping to double your money. That is the worst possible objective you can have. So Reagan, be diligent, put aside money regularly, or talk to your broker. Ask them questions, talk to your dealer, ask them as many questions. And sometimes, even when you have all the information, just sit it out. Say, okay, I would have put 100 million, but let me watch and see if it would have made sense. With time, you get answered in very many ways. So it's definitely not betting. Many people are making a living off trading these shares, and there's a lot of money to make. This moves the economies globally, but we're just starting to appreciate it in Uganda, and it can really work for us as retail investors to meet various financial needs. It's not betting, it's diligent research, and also very habitual saving. Just to comment one thing on Benson's, because we deal a lot with retirees. I found his very interesting, the option of goats and farming. And it is something that for retiree keeps them busy and keeps them looking forward to the next step, because that's also another challenge in retirement. However, you know, I wouldn't advise Benson to give up farming. I would say on top of that, make some investments that you can convert into cash the very next day. I mean, the worst possible example right now are the medical bills that many people have to meet because of the pandemic. I mean, if you try to sell off 100 goats in one day to meet a medical bill, you will find it extremely difficult. However, I can assure you that if you want to sell a bond of, you know, a government bond, it will not take you 2 days. You'll have converted that bond into cash, and you will be able to meet your medical expenses. So balance it out. Don't leave the farming, but by all means, you must have some liquid assets which can meet your needs and also can help you in your day-to-day living. Let the farming be to keep you busy, to, you know, keep some money coming in for groceries, but for emergencies, make sure you have a more liquid asset, which in this case I would say government bonds, government securities, or even some shares that you can sell off in an instant. Not all of them, but some are really that liquid. Thank you very much, Andrew. I'm going to wrap it up with that.
Thank you, George. Mr. Simon Mwebaze, in 3 minutes, answer those questions and wrap up as well.
All right, thank you. I just want to, there was a question about Stanbic wanted to be the next CIPLA. I don't know what's the magic about CIPLA, but I just want us to be certain about one thing. When we say the stock market, it makes it seem like a fancy word, or maybe something of Europeans and all, but try to imagine it this way. You know, Stanbic Bank is a financial institution that has people who are waking up every single day that probably we know. Maybe we have friends or colleagues who work there, or relatives who are waking up every single day to make sure that they make that place different, they grow the brand, they take market share, and that's their job really, and they're doing that every single day. When you put that into, when you think about that and you put it into perspective, then you'll be able to separate what the stock market is vis-a-vis what the reality is. And then you'll ask yourself, are these guys doing a good job in making that difference? Are they, and a good job here will define it by, are they making money? Are they profitable? And is that likely to continue? Where are their competitors? Where is DFCU? Where is Bank of Baroda? Where is KCB? Where is Equity? Where are they? What are their people saying? Where do they project themselves to be? Where do they think they'll be in the next 3, 4, 5 years? Because at the end of the day, it's competition. So one bank is trying to grow its brand, serve its customers, penetrate its niche, and the other, and while at the same time, it's also trying to protect already what it has. While the other bank is also trying to do the same, but on top of that, get more clientele from this other side. When you think about that and you mentally try to view who of these is likely to turn out the best in the next 5 years, it will help you navigate the stock market actually very easily, beyond what is the share price of Stanbic Bank right now, where will it be next week, next month, next year. Then another thing you should note is many of these investments, especially in the stock market, even in the bond market, you need very little money. There was a question about minimum investment. You can invest for as low as 50,000 shillings. And Bank of Uganda is working on a product that will enable investors or Ugandans be able to buy these government bonds that the government issues from time to time on their mobile phone using mobile money. And I think you'll be able to invest as little as, I think, 10,000 shillings or something like that. So you can see the advantage of the capital markets is the minimum investments are relatively low, meaning you can actually create that habit and just keep doing it. And it's easier to follow these things. It's easier to move from all what we are saying to actually implementing by making a first step. No one will ever learn how to swim by just watching other people swim. You have to dive in the pool and try it out. And life is like that. As long as you never try, you will never know. And if you never know, then you can never even get the benefit of having known or not known. So it's always important. You can enter in with very little money and keep growing it. It's easier to follow things where your money is. Your heart is where your money is. So you're able to track, follow, and then start asking yourself those same questions of these three people who I'm making a bet on. Who is going to take me to the promised land fastest? Is it going to be Stanbic, DFCU, etc.? And the opportunities are there. The market is always open. It's open every day of the week as long as there's no public holiday. So you can easily come in, make a move, keep doing it, and get some bit of financial acumen going. Then another thing that you need to think about is, I don't know, still using that same analogy of our colleagues that we know who wake up every single day to work for some of these companies that are listed. I don't know whether many of them will stop going to work because it's an election year, or I mean, we're in a pandemic. These companies have to figure out a way of how to service their customers. So like what we normally do, you'll be surprised how many opportunities present themselves, especially during election years. My colleagues have mentioned how interest rates went up and people took advantage, and probably even how stock prices went down because of the election anticipation. Now, stock prices going down, wonderful buying opportunity if you really know what you're doing. So you shouldn't allow the noise of politics to come in and distort what would be a wonderful opportunity. The most important thing is to make sure that you are sober always, you have a level-headed mindset, and you're able to dissect what makes sense from the noise. I remember, as an example for Umeme, prior to the IPO, there was all this story about the kind of contracts, how MPs were taken into a certain hotel and told to just rubber stamp. It could have been true, it couldn't have been true. But at the end of the day, the company listed its shares went public. They listed at about 200 and something shillings. They went as high as 500 and something shillings. Investors have been earning dividend. There is a news article, if you can search. I think there's a point in time when NSF made, I don't know, some good crazy billions as a dividend from Umeme. Now that is what is real, beyond the noise. And you need to be able to again sieve that. So shall you wait for the clouds to first come and you see the first drop of rain to sow your first seed? You may most likely miss the opportunity. I just want to wrap up by mentioning that I don't know whether Andrew you charge me, but for any keen observer that has noticed, my background has UAP Old Mutual there. So what we do is we specialize in investments and investment management. We have a number of retail and corporate solutions that you can consider. And many of these solutions, by the way, minimum investments are really low. You can get in and grow. It's all about growth. You see your wealth growing, you see your growth growing, and we can also help you cultivate your discipline and also handhold you on your personal finance journey. So Andrew, I just wish to conclude there. I just want to thank you so much for this wonderful opportunity. And I know all of us will do very well in our investments. And let's be positive. Let's be positive. Let's be energetic. We are the ones who people will be depending on very soon for solutions, or even they're already depending on us for solutions. So please go ahead, invest, develop the discipline, and watch your capital grow. Thank you.
Thank you, Simon. We shall send you a small invoice of $10,000 for the Kalango. Hey, Joram, you have 2 minutes to re-echo the answer you gave on the technology and wrap up as well. I pray this time your connection is good.
All right, thank you, Andrew. As Simon has mentioned earlier, is on the opportunities. However, we now appreciate that, with the disruption, we still need to operate smoothly. So yes, technology is quite key for this, from a client perspective, to the entire operations of this. So one is definitely there are initiatives that are being worked on within the different brokerage houses. At SBG, we're currently developing a solution that would enable you, trade off your phone and, try to settle directly into the exchange, as well as also try to enable some of, the payments to be, more of an e-wallet kind of solution. So that is definitely coming in, but also technology does not just stop on enabling you to actually execute. So technology should also come in form of more of artificial intelligence and robotics to just guide you and say, historically, this is how this thing has been performing, likely should perform like this. So that is also, helps with more making you a very informed investor, in addition to the actual knowledge you have achieved over time, and results into you making, quite good investment, taking good investment decisions. My last words or my piece of advice to our investors here is, one is you must put this into action. You need to start now. Simon had mentioned earlier, you don't need really so much to actually start. And two is you don't have to be emotional while making these investment decisions. Don't say, because my husband is maybe the MD of this company, I'll buy that company based off that. No. So you need to take out the emotional part as you make your investments, and try to take, and that's how you result in taking taking up on the opportunities out there in the market. Again, Andrew, sorry to advertise this again, but in case you're interested in getting more information about the capital markets, research, speaking to an investment advisor, feel free to reach SBG Securities. Our details at the Securities Exchange can provide. You can reach me or one of my colleagues. Beg to submit that. Thank you.
Yes, thank you very much, Joram, for those closing remarks. If we had the chance, we would have loved to spend the whole day, because these topics are usually extremely hot. But as you notice, most of these panelists and people in our audience are brokers and traders. So we thought if we could stop here, we could give them at least about an hour and a half to run to the market and conduct some trades. For the questions we have not been able to answer, you can post them on our Twitter handle at the Uganda Securities Exchange, or send an email to info@use.or.ug. Our CEO is our host, who would have made some remarks, but we had already had some engagements. I would like to thank our organizers at the exchange, specifically Salma, Shane, the depository, Bob, the people who have made this day a success. To our investment grandmasters, Samson, Joram, George, thank you very much. You've really been the best of the best for this day. Thank you for the nice information you've shared. We really appreciate whoever is in the audience, whether you're on Mount Everest as an investor, or as low as the lowest place, South Africa or New Zealand, the Southern Hemisphere. We really appreciate your time. We don't take it for granted. And we are available for those of you who may be interested in learning more about investments. We are just a call away. We really never take it for granted. So until next time, Stay safe, stay blessed. May God watch over all of you. Thank you so much for being with us. Good day.
Thank you, Andrew. Have a good afternoon.
Thank you, everyone.
Thank you, Andrew. Have a good afternoon. And to the rest of our guests, have a good day.